Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. This is Investment Friday again. I'm here with, I'm your host, Hannah Chapman, and I'm here with the Chief Investment Officer of Juncture Wealth Strategies, Mr. Brad Haines. How are you doing today, Brad?
I am doing great. How are you, Hannah?
I am really good. I had a great day. I actually recorded another podcast this morning for someone else's podcast, so that's always fun. I don't have to do any of the other work, right? Yeah, good meetings, connect with clients. It was great. So
Good.
those are some of my favorite days.
That's perfect.
What are we looking at? It's December. Today is December 7th. We're recording this on Thursday, December 7th. It's 5 p.m. Markets were up today. This will come out on, Friday, December 8th. So we're a week in to December already. How's it going so far?
It's actually going quite well. In fact, what's interesting is I've been talking with clients as you have, and I'm comparing the market pre-October 19th, year to date through October 18th, compared to a market that is post October 19th, and they're the mere opposites of each other, which is wild for people to think that on one day things can flip in a 180 degree, but yet it has. And so talking a lot about the reasons for that and what we can do to exploit that to make some money over the next couple of quarters.
So tell us more about that, because I think that's really important to keep talking about, because throughout this whole year, basically, we've been talking about the Magnificent Eight or the Stupendous Seven, right? The top 7 or 8 stocks in the S&P 500 that had been just charging forward and really creating most of the returns that we were seeing all year. So up until October 18th, I think is what you're saying, because on October 19th, we saw a significant shift in the stocks that were coming up, right?
That's exactly correct. So up until October 18th, the Stupendous Seven, the Magnificent Eight, however you want to term it, owned the marketplace. They performed almost all, if not over, the total return of the entire market. Everything else was kind of just struggling along, barely making positive returns or slightly negative returns on average. But those 8 were up so much that they actually were providing a large boost to the headline indices. So like the S&P 500, which has a concentration issue in these top 8, it was really providing them kind of a lift. Now, since October 19th, you've seen the exact opposite. So actually the S&P 500 is one of the laggards since October 19th. Why is that? Well, the market is broadening out. And so what worked pre-October 18th is now lagging post-October 19th. And what did not work prior in the year is now working. And it all has to go back to the change in yields. Look at the change in the 10-year U.S. Treasury yield. It peaked on October 18th at 5%. And so we'd have a huge rise in the U.S. Treasury yield, really since April all the way through October 18th, from roughly a 3.5% or a little under to a 5% yield. And then because of some economic data that came out, some comments from some Fed officials, all of a sudden that day, people determined, you know what, maybe the yields have gone up too much, given the disinflation we've been seeing in the economy, given the weakening, but yet still strong, but yet weakening labor market, the continued expectation for disinflation between now and the next few months. in the next couple of quarters, actually. And so all of a sudden yields start dropping. And the expectations that the Fed will cut interest rates started going from late in 2024 all the way to now, end of first quarter 2024. Some people, some investors are expecting a interest rate decrease. In fact, right now the futures markets are saying, hey, somewhere between 1.25% to 1.5% of interest rate decreases will happen in 2024. So what happens? Lower interest rates means lower interest costs for corporations, which means someone's earnings are going to start to pop up because those interest rates, those interest costs are now lower. What areas typically do best in that type of environment? Real estate. Real estate's up 14% since that day. 14%. That's still with all of the issues with office, everybody not returning to the office. So a lot of vacancies in the office space. REITs have really, really rebounded very strongly. Similarly, the Russell 2000, which represents the small cap, the mid cap, the smaller companies who are more reliant upon bank financing than the large companies. So the Googles, the Microsofts, the Apples, they're not really levered. They just have tons of cash flow, and they're not really that levered in terms of a corporate balance sheet. They've done well, but their earnings are also not going to grow kind of in a levered way if interest rates start to go down. Whereas small cap banks and real estate will do that. And so you've seen investors start to shift the money into those areas that are very inexpensive on a relative basis, trading at almost historic cheapness relative to large caps. So those areas are really starting to pop.
And so you kind of alluded to this in what you were just saying, but let's talk a little bit about inflation and the jobs report that just came out.
Fantastic. So earlier this week, we got the JOLTS survey, which is job openings and layoff and turnover survey, which is essentially how many jobs are available out in the workforce. Okay. We've had, all the way to almost 11 million jobs available. And the announcement came in much weaker than expected. I believe the expectation was for 9.3 million jobs would be available, and it came at 8.7. And they revised the prior month lower. So again, whenever we get these preliminary data, the agency or the group responsible for putting that data together, they have a preliminary announcement, and then they always revise it as they firm up their numbers and they get more clarity and accuracy. And so that was a big surprise on the downside, which means what? Probably a weakening labor market, even though it's coming from a very, very strong level. One of the things that you and I talked about a lot is the job openings per unemployed worker.
Right.
So how many jobs are available per unemployed person? Well, we peaked out at two times, so 2 jobs for every unemployed worker. Last month it was 1.5. It had fallen to 1.5, and with Tuesday's announcement, it is now 1.3 jobs per every unemployed person. Still very, very strong. I mean, the long-term average is 0.6, 0.7 jobs for every unemployed worker. One of the things that's also happening is you're having a lot of people come back into the workforce, starting to look for jobs again. So some of that unemployment rate that we might get might be a little more elevated this time relative to the past couple of months.
Yeah, because that would make sense that, job openings were high when there were fewer job seekers. And now if more people are looking to get back into the full-time job market, that ratio is going to compress somewhat.
Absolutely. And it's going to slow down, wage inflation. It's going to, tomorrow, or i.e. today, if you're listening to this on Friday, we get the unemployment rate. And Bloomberg economists believe it's going to be a 4% inflation rate, or excuse me, a 4% unemployment rate, up from 3.9. So if we do that, again, it's not a disaster. It's just telling us that, hey, we're starting to, the labor market is starting to weaken somewhat. And so maybe workers don't have the power to demand higher wages at the same rate as they did over the past couple of years. And so that's a really good thing for inflation coming down, which again allows the Federal Reserve to say, okay, maybe rates don't need to be this high, or at the very best case scenario, maybe we should drop rates a little bit, which will be very supportive of asset markets.
I'm just continuously not surprised, but it's so fascinating to really like look at the intricacies of how this actually works, right? That we can see, what's potentially coming down the pipeline with interest rates when we look at the jobs, when we, pay attention to inflation. It seems like a big ask, I think, to say that we would be cutting rates by 1.5% in 2024. That seems like a lot. So the question that I want to pose is, if we were to not experience, right? Because this is kind of the thing that happened this year a lot, was the Fed would say one thing. They would basically say, like, we're not, we're not cutting rates. We're probably going to raise rates. And the market would almost take that and do the opposite thing that you would expect, right? So there was like this mismatch, it seemed, of, what was being said and then what was happening in the market. So if this is the expectation, right, or we're actually seeing that kind of priced into the futures market, which is how these predictions kind of play out, right? We're looking at, what are people betting on? That's what the futures market is. What are people betting on? Like a horse race in the future.
Exactly right.
I mean, basically. So people are starting to bet more heavily on, what are the odds that rates will come down that far? So what happens if we get to, end of quarter one and then into quarter two, and rates have stayed steady? That's kind of what I'm wondering.
Yeah, so that is actually a Juncture Wealth Strategies. That is our base case scenario, is that um, interest rates are going to stay stable for a much longer period than I think people believe. I mean, the good thing is we've disinflated from 7.1% on the CPI in January of this year, and now we're down to, depending on the measure you look at, 3 to 3.25%, from last month. So great job. It's come down a lot. However, that target is still way above the 2% number.
Mm-hmm.
And based on some things going on, does it get down into the near the 2% target, which the Fed has said they really want to obtain? So we think at Juncture that that first of all, people have gotten way too excited about lower interest rates early on. We just don't think that's going to happen. We do forecast, similar to the OECD, we do forecast a very kind of a break even economic growth through the first half of next year, which will allow the Fed to see what inflation is doing. We think they're going to be on hold. We think the economy is going to be at a break-even rate, and then we'll see the dynamic between inflation and interest rates. And then by mid-year, we think that if the economy has slowed to a certain extent without some kind of credit event, then the Fed will probably feel comfortable starting to lower those rates a little bit. 1.5% is an aggressive move in an economy that, to be honest, has been pretty decent, even at a break-even rate. It's still much better than could be expected. Now, we have the waning impacts of fiscal stimulus or the fiscal help through the primary deficit, and so that is kind of part of the equation as to kind of a slowing economy, slowing consumer spending because of slower wage growth, weaker job markets. Again, all really, really healthy, not necessarily a disaster, but we should reaccelerate into growth at the second half of next year.
One acronym you threw out there, OECD, I think is
Yep.
what you said. Tell us what that means.
Organization for the Economic. I'm going to get this wrong, and this is going to bother me.
Uh-oh.
OECD. It's the Organization for Economic. I got to look it up.
You can Google it.
I got to look it up.
Didn't mean to put you on the spot there, but you said it, and I was like, wait, I don't know if I know that one. And if I don't know that one, then listeners don't know that one either.
That's true. Man, I don't know if I've ever actually known it.
That's part of the problem with our jargon, right? We just throw out all these acronyms all the time.
OECD. Oh, Organization for Economic Cooperation and Development. Wow, I did know that. But again, I always call it OECD, and everybody else does too. So I apologize.
Yeah. Well, yeah. Tell us a little bit more about that, kind of passing comment that you made with that.
Well, which one?
That you believe. I mean, it was similar to what I just said. Like 1.5% seems, pretty. I'm gonna say optimistic. To think that we would drop that far in interest rates, and you said yes, and similar to what the OECD is forecasting.
Yeah.
So what are they looking at?
Yeah, the OECD is basically forecasting for the first half of next year a slightly negative GDP growth rate for the United States, and we're similar in that. We're also in that camp. We think that one, slowing labor market, slowing wage growth. You have fiscal impulse or fiscal pulse starting to fade in the background a little bit. You have consumer spending with the credit cards that have been run up so much. We're going to see a weakening in that consumer spending. In fact, fourth quarter this year, we should probably see a lot of that happening, starting to make an impact. So it'll be interesting to see how the retailers, both online and brick and mortar, come out with their holiday sales updates. We're going to watch that really closely because that's going to be a barometer of how the consumer is doing. So slower consumer spending, weaker job markets, fiscal stimulus that's coming to the background, and we've had tighter monetary policy that, with its long and variable lags, is starting to take an impact. And so generally takes about 2 years from the time the Fed starts to raise interest rates for it to have its full impact and bite into the economy. And guess what? March of next year is that 2-year period. So again, we're forecasting a slightly negative, not a massive, but quote unquote, a recessionary type environment, which again, leading economic indicators have all indicated that we're going to be doing that. Our inverted yield curve for the better part of a year and a half also has indicated that we're probably going to go into recession. But again, very slight, very, very shallow. And because it was somewhat caused by the Fed's higher interest rates, it can also be fixed by the Fed as long as there's not a credit event that is caused due to the higher rates.
So one of the things that you just mentioned, I think goes really well into our question for today. So Bob, Thank you for sending this question last week. And Brad wasn't able to record, but he did send this one last week, and I think it still applies today. Was that November was a pretty epic month. There was a big upswing in the market in November, and will December be bullish? And I think a lot of that depends on, like you said, those retail numbers. So what do you think?
So I think Bob's going to be pretty happy. I think that the equity prices are going to maintain its momentum through the end of the year. If we look out prior to the 3 prior months to October or to November, they were negative, and they were pretty negative. So coming on the back of 3 negative months, November rebounded significantly. And again, we've talked a lot about what rebounded, relatively speaking. And I think going in towards the end of this year, we're going to have a pretty good pop in equity markets. Again, depending on the context of your portfolio, you may participate more or less depending on what you own. But I think it's going to be a bullish environment. And then in January, February, we might have to reassess depending on what the economic data is telling us, because people might transition from worrying about yields to, oh my goodness, this is a slowing economy. What's this going to do to earnings?
Mm-hmm.
This is going to translate to earnings. Lower earnings could have a correction in the first quarter of next year.
Well, we will be interested as always to look for that. And I'm interested to see what kind of what Black Monday, Black Friday, Cyber Monday, there we go. Cyber Week, as some retailers put it. Now I'll be interested to see what the numbers look like from that. So we'll go a little bit into retail here for a second, and then we'll wrap up. But a lot of the Black Friday, quote unquote, Black Friday sales were actually not Black Friday sales, right? There was like not the traditional deep discounts that we've seen previously that, caused people to buy extra, right? Or save all their shopping. Or a lot of people, who traditionally do save a lot of their shopping till Black Friday, were not actually experiencing savings that were more literally the same as, like this is the Black Friday sale. Like it was the same yesterday. It didn't change. At retailers like Target and, other places where it was like 20% off versus 50 or 60% off type thing. So I'm wondering what kind of impact that will have on consumer spending as a whole, since that is kind of like the kickoff to a holiday spending season.
Yeah, it's a great question, and we're gonna have to wait to see what the data implies, but it's not great. I mean, if you also notice, not only was the price were the prices a little more firm in terms of the sales, but also they drug forward Black Friday. They started to say, hey, we're doing it early this year. We're doing it and a couple weeks early. So I think that loses its impact when you try to spread it out. And they're trying to do that because there's a lot of inventory. And when
Mm,
you have a lot of inventory and you want to get rid of it, you try to do it at first by selling it at the same average selling price, but over a longer period of time. And then when you can't, if you still have a lot of that inventory getting closer to the holiday, you're going to start discounting those prices to get rid of it. And that's what we have to watch for, because if they are able to sell at the higher prices, they will do that, and that is indicative of really good consumer spending. But if you start to see, as you get closer to the holiday, the Christmas holiday and New Year's, if you start to see a lot of discounts online or in your brick and mortar stores, that's probably indicative that the holiday season hasn't been fantastic, and maybe a cautionary tale for the economy in 24.
huh. Well, interesting. I feel like we were more pessimistic this week than usual.
Also, this is something I had to talk about with clients this week is we've converted to bad news is good news for the equity markets and the bond markets. Okay. Good news is now bad news. So, less people having jobs is a bad deal if you're that person. But overall, for the equity markets, because they're forecasting out 9 to 12 months in the future, they're saying, okay, higher unemployment means less inflation, which means lower interest rates, which means higher earnings. So the equity markets go up based on that higher unemployment. So it's, again, bad news is now good news for equity market prices and vice versa, which is a weird connection. And a lot of investors have a difficult time with it. But you're right. It can be very pessimistic sounding, but your balance sheet can continue to appreciate based on that.
Well, that's the key there, right? Is not just seeing the data or hearing the data, but being able to actually interpret the data and make decisions based on where the market's going versus where it is right now or where it has been in the past. That's why we have jobs, right?
That's exactly right. That's exactly right.
Well, excellent. Thank you, Brad, as always, for being here. And if anyone wants to get in touch, you know where to find us. You can email me at Hannah, HANNAH, at expansiveceo.com. If you have any questions that you would love for us to answer on the podcast, we would love to hear from you. You can also visit my financial planning website at x2wealth.com, x the numeral 2wealth.com, to learn more about that. And Brad, where can people get a hold of you?
You can get a hold of me either via LinkedIn, or you can email me at bhaines, BHAINES, at juncturewealth.com. I would also like to say that in about a week's time, we're going to have our 2024 presentation that will have a narrative and charts and graphs that go into what we expect for 2024 from both the economy and the investment markets. And if anybody wants a free copy, please get a hold of us. We'd love to send it to you.
So that is going to be a great report. If you are at all interested, if you've listened to every Investment Friday because you're totally into it, and I know there are some of you, email Brad or email me, and we'll get you. We'll send that out to you. You can have that PDF of what Juncture is expecting for 2024. We'd love to share that with you and share the knowledge, share the strategies, all of that, so that you can, be informed with us. I love that. Thank you, Brad.
You're welcome.
We will see you next week. Thanks, everyone.
Have a good one.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com, and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough. You are enough. And your birthright in this lifetime is to be expansive.